If you're a business owner sitting on unopened IRS letters, payroll issues, or growing tax balances and hoping it would all just go away, this video can save you tens or even hundreds of thousands of dollars. Hi, my name is Mia Taylor. I'm an enrolled agent and a tax advisor. And today, I want to speak with business owners who are dealing with back tax issues that are ranging from $50,000 to $100,000. Those who have waited too long because they were simply overwhelmed, scared, or unsure where to start. I want to go through the different types of tax debts. I want to talk about why IRS notices can turn quickly into collections, how audits truly start, and most importantly, what you can do right now to stop things from getting worse. Not all tax debt is the same. One of the biggest misunderstandings is business owners think that tax debt are all treated the same, when it's simply not. There's two types. One, there's income tax debt. This typically comes from underreporting income, overstating or unsupported expenses, missing or incorrect filings, and this often happens when bookkeeping is poor, when expenses cannot be substantiated, when returns are prepared with incomplete information. When the IRS disallowed expenses, the tax bill just increased faster and the penalty and interest followed. The second is the trust fund tax debt. This is more serious, guys. Trust fund taxes include payroll withholdings, federal income tax withheld from employees, Social Security and Medicare taxes. These are not your funds. They are held in trust for the government. A very common scenario I see is payroll is set up, payroll is ran, but the federal and state payments and filings are never set up or monitored. This leads to what we call a trust fund recovery penalty audit. Personal liability for the business owners are at risk, and in many cases, aggressive IRS enforcements are intact. So, how do business owners end up in audit? Most audits don't start randomly. They usually start because one, expense claims do not match the income reported. The numbers don't align with your industry average, or documentation just can't be provided when requested. If you claim expenses you can't prove, the IRS doesn't negotiate. They just simply disallow them. And when expenses are disallowed, here comes the big tax bill. What happens when you do not respond to a tax notice? Well, here's the part that catches people off guard. Once the IRS issues a tax notice, you generally have 30 days to respond. If you don't, the assessment can sometimes become final. I mean, there's some other steps in between, but it quickly moves into collections. And once you're in collections, here come the following. Penalty and interest continues to grow. Levies and liens become possible. And the IRS has 10 years to collect from the date of assessment. The only way to change the assessment later is to provide new evidence that was not previously considered. Waiting does not help your case. It weakens it. What should you do instead? Well, here's what every business owner should do when facing IRS notices or tax debt. One, respond to the notice. Silence is the worst response. Two, request information from the IRS. This is your information. The IRS is not allowed to withhold it from you. You can and you should request the following: your transcripts, audit work papers, if any, assessment details, payment histories, if it's all there. Usually you can find on the transcript. Three, identify the root causes. Here's the questions you should be asking. Is this income tax related? Is it payroll related? Is it bookkeeping related? Is it tax return filing related? You can't fix what you don't understand. The fourth, gather real evidence. The IRS operates on documentation, not explanation. Receipts, bank records, payroll records, accounting records. Evidence changes outcomes. When you can't do this alone, what happens? Many business owners reach a point where they realize, oh my God, this is too big for me to fix. And that's okay. But now it matters who you work with. This is where an enrolled agent comes in. Enrolled agents are federally licensed tax practitioners. They're authorized to represent taxpayers before the IRS. They are specialized in audits, collections, and IRS resolution. Some are licensed to practice before the U.S. tax court. This is not the same as a general tax preparer or an accountant. Why back taxes must be fixed before planning. So here's something I want to be very clear about. You cannot do effective tax planning while back tax issues are unresolved. True tax planning requires the following: clean compliance, accurate records, proper systems, and consistent follow-through. Fixing the past allows you to protect your future. This means changing how payroll is handled, improving bookkeeping, setting up proper filing systems, and managing finances intentionally. This is how you stop repeating the same problem. At the end of the day, there are only two choices. One, invest in fixing the problem. Or two, do nothing and let tax debt compound until it takes everything. Ignoring the IRS doesn't make the problem smaller, it hands control over to collection. With the right team, you can deal with both the past and the future and finally move forward. Listen, if you're a business owner dealing with tax audits, notices, or tax debt, the most important step is first addressing it instead of waiting. This is not about fear, it's about clarity, strategy, and protecting what you've built. And before you go, remember to like, share, and subscribe. It helps this information reach other business owners who are silently struggling with real need for advice. Listen, I hope you found this video to be very helpful. And if so, I'll see you on the next video.